Stop what you're doing and listen carefully, because what I'm about to share over the next 30 minutes could become the most important financial decision of your entire life. Not just this year, not just this decade, but your entire life. I've spent more than 40 years navigating markets through every imaginable crisis. The Black Monday crash of 1987, the dot-com implosion, the financial meltdown of 2008, and the unprecedented panic during COVID. I've witnessed events that would make most investors abandon this business entirely. And yet, in all these decades, nothing I've ever seen compares to the conditions forming right now. What I'm about to explain isn't a guess or a projection born of fear. It's pattern recognition, honed over 4 decades of watching how financial systems fail. And the pattern emerging now is louder, clearer, and more urgent than anything I've encountered in my career. Imagine waking up one morning to check your banking app, only to see a notice that withdrawals are immediately limited. ATMs are capped at $300 per day, wire transfers require 5 to 7 business days of review, and online transfers to external accounts are temporarily suspended pending regulatory guidance. Your first reaction is panic. Your second is confusion. And if you're like most Americans, the third is a sense of helplessness because you have no plan. You never thought it could happen here, not in America, not to you. But history shows otherwise. That's exactly what people in Britain thought in 1992, Argentinians in 2001, and Cypriots in 2013. All of them were wrong, and by the time they realized it, it was too late to act. Today, I'll walk you through precisely what bank withdrawal restrictions are, why they occur, the warning signs that appear before they hit, and most importantly, the steps you need to take right now to protect yourself and your family, not after the news breaks. Right now, because once headlines appear, the window to act has already closed. Let's start with Cyprus in March 2013. An event most Americans have forgotten and that forgetfulness is dangerous. The Republic of Cyprus had 2 major banks, Bank of Cyprus and Laiki Bank. Both were enormous relative to the size of the Cypriot economy and heavily exposed to Greek government bonds. When Greece faced its debt crisis, these bonds collapsed in value, leaving both banks insolvent. Not struggling, not experiencing a tough quarter insolvent. The European Union and the International Monetary Fund intervened with a bailout, but it came with a shocking condition. Depositors with over 100,000 euros would have a percentage of their funds seized to help finance the bailout. Before this was publicly announced, the Cypriot government did something unimaginable. It closed banks entirely for nearly 2 weeks. ATMs ran dry. People couldn't access their own money. When banks finally reopened, withdrawals were capped to a few hundred euros per day. This wasn't because Cyprus was a poorly run nation. It was a sophisticated European banking system collapsing overnight due to interconnected financial failures. And the government's response was not to protect depositors, but to protect the system itself. That phrase, to protect the system, is crucial. Whenever governments or central banks restrict access to your money, it's never truly about you, it's about the system. Now let's bring this closer to home with Silicon Valley Bank in March 2023. The speed of this collapse should terrify everyone watching. SVB wasn't a small community bank. It was the 16th largest bank in the United States, holding $209 billion in assets and serving thousands of tech companies, startups, and venture capital firms nationwide. It failed in just 48 hours. SVB had invested depositor funds heavily in long-term government bonds when interest rates were near zero. When the Federal Reserve raised rates aggressively starting in 2022, those bonds plummeted in value, creating enormous unrealized losses. Word spread quickly through venture capital networks via texts and social media, sparking a bank run. Depositors attempted to withdraw $42 billion in a single day. The bank could not meet these demands and collapsed, with the FDIC stepping in to take over. Ultimately, the federal government guaranteed deposits, but only after the collapse, after panic spread, after the run had occurred. Imagine being a small business owner or a regular depositor, waking up to find your bank gone, your money inaccessible, and no idea if you'd ever see it again. This was not a third world problem. It happened in California in 2023, and the conditions that caused it have only worsened. People focused on SVB's specific failures, bad bond investments, a concentrated depositor base, and social media-fueled panic, but they missed the broader truth. SVB was a symptom of a systemic problem affecting nearly every U.S. bank today. The Federal Reserve's aggressive interest rate hikes left banks holding long-term bonds and loans purchased during the zero-rate era with hundreds of billions in unrealized losses. Estimates put total hidden losses across U.S. banks between $600 billion and $700 billion. These losses aren't always visible on balance sheets because accounting rules allow banks to classify bonds as held to maturity, masking the true financial fragility. Understanding how banks operate is crucial. Deposited money doesn't sit in a vault with your name on it. Banks lend and invest these funds. Under the fractional reserve system, only a small fraction of deposits is kept on hand. This system works as long as withdrawals remain normal. Once confidence falters and many depositors rush to withdraw, banks cannot meet demand. That's a bank run, and in today's digital age, it happens faster than ever. Bank runs used to take weeks, giving regulators and banks time to respond. Now, a single text message or a viral post on Twitter or Reddit can trigger billions in withdrawals within hours. SVB lost $42 billion in a single day, executed entirely through digital channels. The next collapse could be faster, and the one after that faster still. While the dynamics of bank runs have changed, the underlying fragility of the system hasn't, and that is extremely dangerous. And stick to it. That plan is your shield when chaos hits. You cannot improvise in the middle of a crisis. The moment you have to make decisions without a framework is the moment you risk losing everything. Think of it like this. In every financial disaster I have witnessed over 4 decades, from Black Monday in 1987 to the dot-com crash, the 2008 meltdown, and even the sudden collapse of Silicon Valley Bank in 2023, the people who survived with their wealth intact were not lucky. They were prepared. They had already taken defensive steps, often mundane, often ignored by the majority. They had cash ready, accounts diversified, assets positioned outside fragile institutions, and a plan they followed calmly while everyone around them panicked. That is the difference between financial survival and financial ruin. Now, let's break down what having a plan really looks like. First, know exactly how much liquidity you need to cover essential expenses for 3 to 6 months. This isn't about exaggeration. It's about being able to feed your family, pay rent or mortgage, buy gas, utilities, and medicine, even if digital banking is frozen. That liquidity should be in physical cash you control, not in some account that could be restricted overnight. Second, know which banks your money is in, and make sure those banks are not all part of the same exposure. A crisis in one bank often cascades into others, and if all your money is tied to a single institution, your entire financial life is at risk. Third, have physical gold or silver in your possession, not just in a financial instrument that can be frozen or restricted. This is insurance against the system itself, failing temporarily. And finally, review every automatic payment, direct deposit, and recurring transfer. Make sure you can manage essential obligations even if one or more banks become inaccessible. Redundancy is not inefficiency here, it is survival. You also need to understand the signals that precede a crisis, because acting before restrictions hit is critical. Deposit outflows at regional banks are an early warning sign. Watch carefully for banks raising CD rates dramatically, for sudden declines in bank stocks while the broader market stays steady, for credit markets seizing up, or for emergency lending programs announced quietly by the Federal Reserve. These are not minor blips, they are red flags. And paradoxically, when politicians or regulators tell you everything is fine, treat that as a signal, not reassurance. They almost never hold press conferences to say everything is fine unless they are trying to calm nerves before a storm. History is full of examples. Argentina, Cyprus, and even the United States, with Silicon Valley Bank. These are not isolated events. They follow a clear pattern. A banking system under stress leads to government or central bank intervention, often restricting access to depositors' funds. The outcome depends on whether the underlying problems are solvable and whether the authorities have the tools and credibility to resolve them. But even with the best intentions, there is always a window where ordinary people can lose access to their money. And in the digital age, that window closes faster than ever, sometimes in mere hours, not weeks. This is why timing matters more than ever. The difference between acting early and reacting too late is measured in financial survival. The cost of preparation, diversifying accounts, holding cash, owning gold is modest. The cost of inaction, if a restriction hits, can be catastrophic. Unable to pay your mortgage, buy groceries, or even access funds for a medical emergency. That asymmetry is what makes defensive preparation not just wise, but essential. Stay calm, stay deliberate, and act before the moment of crisis arrives. That is how you protect yourself, your family, and your future. And in the next section, I will walk you step by step through the exact actions I would take today if I were a regular investor trying to shield myself from bank withdrawal restrictions. Practical, concrete steps you can implement immediately. Let's get practical. If I were an ordinary investor sitting at home today, here is exactly what I would do to protect myself from potential bank withdrawal restrictions. Step 1. Diversify your banking relationships immediately. Do not leave all your money in a single institution. That is a risk you do not need to take. Open accounts at multiple, genuinely different banks, a large national bank, a regional credit union, and a separate online bank. Each of these institutions has different balance sheets, different exposures, different risk profiles. If one bank freezes or restricts access, the others remain accessible. This is about creating a safety net, not complicating your life unnecessarily. Step 2. Understand FDIC insurance limits and position your deposits accordingly. FDIC insurance covers up to $250,000 per depositor per bank. If you have more than that in one place, restructure your accounts before a crisis hits. Use joint accounts, retirement accounts, and trusts strategically to maximize protection. During a crisis, your ability to move money or restructure accounts can vanish almost overnight. Do it now. Step 3. Maintain a meaningful physical cash reserve outside the banking system. I'm talking about 3 to 6 months of essential living expenses, rent or mortgage, groceries, utilities, fuel, medications. Store it securely in your home, not under a mattress, but in a proper safe. Cash is your ultimate lifeline if ATMs are capped, online transfers are blocked, or banks impose limits. No digital workaround can replace it. Step 4. Own physical gold and silver, not ETFs, mining stocks, or futures. Physical metals in your possession are immune to bank freezes, regulatory restrictions, and digital disruptions. This isn't about speculation, it's about insurance. A modest allocation of 5 to 10% of your net worth in physical precious metals held securely outside the banking system can provide unparalleled stability in a systemic crisis. Step 5. Reduce your dependence on a single institution for critical financial functions. Many Americans have their paycheck, mortgage, credit cards, and bills all linked to one bank. If that institution hits trouble, your entire financial life freezes. Spread your obligations. Have a credit card at another bank, a checking account elsewhere, and alternative payment methods ready. Eliminate single points of failure. Step 6. Consider assets outside the traditional financial system. Real estate owned free and clear, a revenue-generating small business, or professional skills and networks are all assets that cannot be frozen by banks. These tangible or personal assets give you security independent of the banking system and can sustain you if the digital financial network is disrupted. Step 7. Reduce leverage immediately. Margin debt, personal loans, or excessive borrowing can be fatal in a liquidity crisis. If markets tighten, banks restrict withdrawals, or panic spreads, debt amplifies losses. Reducing your exposure now preserves your flexibility and your ability to act calmly. Finally, step 8. Have a written, specific plan for every contingency. Know exactly what you will do if restrictions are announced. Which accounts will you access first? How much cash will you withdraw? Where will you allocate precious metals? What bills must be paid immediately, and which can wait? This is the difference between calm execution and frantic improvisation. Taking these steps is not paranoia, it is preparation. The cost of being prepared is minor foregone interest, minor inconvenience, a little extra effort. The cost of being unprepared is potentially catastrophic. You cannot afford to treat this as theoretical. In every financial crisis I have witnessed, the people who survived and even prospered were the ones who took deliberate, early action, while others waited, hoping the system would remain stable. Now let's talk about the moment of truth, what you do immediately if banks actually impose withdrawal restrictions. This is the 24 to 48-hour window that can define whether you weather the storm or get trapped. First, stay calm. I mean this sincerely. Panic is your enemy. It drives rash decisions, fires off desperate transfers, and forces you to sell assets at the worst possible time. Calm, deliberate execution wins in crises, not emotional reaction. Second, execute your predetermined plan. If you followed the steps I just outlined, diversified your accounts, kept cash on hand, stored physical gold, minimized leverage, then you already have a roadmap. When restrictions hit, there's no scrambling. You act according to your plan, step by step, without improvisation. Third, resist the urge to make dramatic, irreversible moves based on incomplete information. In the early hours, news is fragmented, rumors are rampant, and digital chatter spreads faster than facts. Wait until you know exactly what restrictions cover, their timelines, and your available resources. Decisions made too early can compound losses. Fourth, focus on essentials. First, food, shelter, utilities, medications. These are non-negotiable. Make sure your resources outside the banking system cover these needs. Once your immediate survival is secure, then think about medium and long-term positioning. Fifth, don't try to be a hero. Don't attempt to time the crisis for a profit or make aggressive financial moves during the acute phase. Those who prosper in crises do so after the panic subsides. Your primary goal in these first days is liquidity and security. Profits come later, once clarity returns. Now let's step back and look at the broader picture. Governments impose withdrawal restrictions not because they want to hurt you, but because they are choosing between two catastrophic options. Let the system collapse entirely or temporarily restrict access to prevent panic from spreading. In almost every case, they choose the latter. They tell the public it's temporary. They claim it's to protect financial stability. What they are really protecting is the banking system itself, not your money. And this is why preparation is critical. Consider the limitations of today's environment. The Federal Reserve cannot slash rates aggressively without reigniting inflation. Printing money risks devaluing the dollar. Political polarization slows coordinated responses. Digital banking runs can erase billions in hours. Ordinary depositors who fail to prepare can face consequences far worse than mere inconvenience. They can face the destruction of years of savings, frozen assets, and financial paralysis. I'm not saying this crisis is guaranteed. I'm saying the risk is unprecedented in my career, and the asymmetry between the cost of preparation and the cost of inaction is enormous. Preparing now costs little: diverse accounts, cash reserves, gold, reduced leverage, and a concrete plan. Not preparing could be catastrophic. So, to summarize, act now. Diversify your banking relationships. Stay within FDIC insurance limits. Maintain a cash reserve to cover essential expenses. Own physical precious metals in your control. Reduce reliance on a single bank for life's critical functions. Lower leverage, and develop a written, actionable plan. Execute calmly if restrictions hit. Prioritize essentials and wait for clarity before making major decisions. The choice is yours. History shows that those who act early survive. Those who wait often lose everything. This is your opportunity to take control, not after the panic hits, but before it ever starts.